clearly there's still a lot of unknowns. So like, if whether there's 10 or 50, the next question then is how does the buy side choose? Not just how does the buy side choose a clearing dealer, but then also how do maybe some of these executing brokers who are not self-clearing, how do they choose a dealer? So what are some of the differentiators? How do dealers sort of make their offerings stand out, and what are people looking at?
Having been involved with the sales process probably since November of 2009, I think it really depends on the type of client you're looking at. You deal with insurance companies, deal with hedge funds, regional banks, et cetera. And some firms basically had a PB relationship or a futures relationship, and kind of piggybacked off of that. But I think what we've seen more often than not is a very lengthy selection process with very long, detailed RFPs. It's a new business for everybody. So I agree with Phil that people are now taking more time to educate themselves. But I think a lot of firms didn't just go based on a relationship. They did these detailed RFPs, and they got their selection process down to from 8 to 5 to 3 to 2. I think at the end of the day, it's been a bit of a dog and pony show, but basically, if you can simulate what it's going to look like in production from an end-to-end testing standpoint and work with clients on that, get them the statements and access to the portals and the delivery mechanisms, then they can really see what your capabilities are. I think some of the key differentiators for folks are, client service model. How do I, support clients from a futures perspective versus a OTC cleared perspective versus a bilateral perspective? Is it one central point of contact? How does my PB group interact with my futures group? And I think a lot of the clearing brokers have taken slightly different directions on this. And again, it's going to be a client preference. But clearing is a commoditized business. Any dealer can go to a clearinghouse and get the reports, and well, one would hope anybody can do it, and report those back in a timely manner, and settle margin, et cetera. I think the differentiators are now what we're seeing is show us your technology, show us your client-facing technology, your margin replicators, go across. I don't want to just see how my margin is going to be impacted if I clear at the CME versus the LCH with you. I want to know how it's going to be impacted with one of my 3 other clearing brokers. So how do I maintain the ability to do that, and still keeping some competitive advantage? Obviously, some of the other things, I think creditworthiness was in corporate credit culture was very important. I think with the LSOC implementation or proposed implementation, that's a bit less important now. You basically have the segregation out there, so you lose the mutualization risk. Obviously, what can I do in terms of collateral services, transformation, upgrade, in terms of, especially for insurance companies and folks like that. Some folks are interested in single currency margining. What are my capabilities in that respect? And how well are my reports basically displayed, and how timely do they come? So I think I think those are a lot of the the key attributes out there. But I think really people testing a clearing broker on what it would look like in production is probably one of the key attributes.
Jeff, in your experience, you said like RFPs and the whole dog and pony show. Do you find that you're competing with the other, say, top 10 incumbent swaps dealers, or are you competing with a whole bunch of new names that you wouldn't have seen before?
We're not really competing with the newer names. I think as the capital requirements are still there, it's your usual suspects. I mean, I think some of the different differentiators sometimes are, some folks took the PV type model, they took that sales approach. Other folks took the futures. We like to say that we saw the agency model coming a little bit before, and prepared more in the futures type model. But I think there's pluses and minuses to either approach. I think one of the key aspects is trying to get people who are educated in futures and OTC derivatives to be able to support the overall business, as opposed to just saying, all right, I'm going to put my futures staff out there, I'm going to put my swaps guys out there, because there does need to be a lot of cross knowledge.
Clearing is a commoditized business as long as you have $5 billion.
Yeah, basically, yeah.
So then the next part to that question is, and unfortunately, we don't have any buy-siders to answer the question on the panel, but will the clearing broker and the executing broker be one and the same, or will people start to execute with some and clear out and give up and clear somewhere else?
I think in the, obviously in the future electronic model, that they will definitely be differentiated, and there will be the anonymity. I think everybody was out there selling the point, and we committed the same as everybody else. If you do the trades with us, we'll clear them for free. Clearly regulation says there needs to be a segregation between clearing and execution. We don't think that that is actually going to be a long-term proposal. We think obviously you're going to probably charge the same fees based on if you're executing or clearing. So I think while that was an early concept, I think over time that's going to evolve, and I don't think you'll see much of a relationship between the two.
And yeah, Phil, you're coming at it from a slightly different angle.
Yeah, I would say I'm not agreeing to something that Nathan brought up earlier, in that I think as the model changes, the who you're dealing with, the credit exposure and the credit worthiness moves from the swaps dealer over to the FCM and the clearing broker. So now from an FCM perspective, the game is all about trying to understand the credit worthiness of the client. So I see that changing the execution side. So back to the earlier point about new entrants coming in and not having to have a huge balance sheet, a huge credit department behind them. But that very much shifts over to the FCM side. So there's a lot of technology needed for that. And a big change then on the FCM side is really bringing a credit, an ability to be able to advance credit during the day, intraday, instead of it being a next day. So a lot in the typical traditional OTC market, credit departments are the next day figuring out the aggregated risk that they have to a client. That needs to get pulled forward, so that we're hearing a lot from our clients is, at what point are you going to cut us off? What is it going to be that that we need to consider as a client of the FCM about how you will deal with us during the day if you extend beyond a credit line, or for some reason a swap doesn't clear. So I think that there's differences there. The other thing I think from an FCM perspective we're seeing, there's a lot of I think as Jeff had mentioned there is a commodity in terms of being able to clear trades and handle margin and cross margin, etc. But there's a lot of interest, I think, in terms of what you can do the same day. So a little different than the futures model, where you really want to see your reports the next day and what happens and how much margin is needed. In swaps, especially where you have large notionals, the amount of margin we're talking about is significant amounts of money that we have, and the decisions, depending on how you split your portfolio about how much margin you need to come up with, can be significant. So we've seen a great interest in there in terms of tools to see during the day, as I'm trading during the day, how much margin am I going to need tomorrow across each of these accounts? What can I net? What can I not net?
Well, and then I guess there are other services. There's margin financing. I assume there'd be the ability to help your clients if they wanted to move and aggregate positions in a particular clearinghouse rather than another. I assume that all comes into the picture as well. Okay, so now we know how to choose a clearing broker. So the next question is then how do you choose your clearinghouse? And we have the three largest ones right here. So why don't you give us your best sales pitch and tell us why?
Carefully.
Carefully.
I'd probably break it down into two kind of considerations that you should have. Is on a practical, everyday, facilitating the trading that you want to do. You want to think about, if you lay it out as like a scorecard. Is the clearing model anonymous? In other words, can you trade with whoever you want? Your clearing broker can't restrict that. Is the clearinghouse connected to the major established CEFs and/or affirmation platforms that you're going to use? Account segregation is less of a consideration, I think, post Dodd-Frank, since that's going to be fairly is that going to be mandated regulatorily. Another thing to think about is the efficiencies that the clearing model brings. So does it have T+1 settlement? Is it at trade clearing? Do you have all your settlement variation, your coupon payments, and everything else netted together into one variation margin payment per day? You want these kind of efficiencies in your clearing model. So that's sort of like key, like everyday trading, how it impacts your trading on a daily basis. But then in times of distress, you should read the rules of what happens and how the clearinghouse handles a default of a clearing member, what happens to your positions and funds in that event, what happens if in the event that the clearinghouse defaults, what happens to your funds and positions, how do we close out your positions, what's the recourse. So you should definitely read through those rules. They're kind of legalese, so they're a little hard to work through, and I've spent a lot of time doing it, but it's very worthwhile doing so. And then finally, I think you want the broadest. I think we're going to be in a environment where you're going to have capital considerations are going to be fairly paramount. So you're going to want a fairly broad product class in each clearinghouse that you can trade in, so you can get realized risk offsets and between different products to get the most efficient use of your capital that you're going to have to post for margin.
Yeah, I mean, look, I think I would agree with everything that Mark said. I think if, would expect the regulators are going to make sure that any clearinghouse is, systemically sound and is part of a sound infrastructure. And, we were talking a little bit, Mark and I, before the panel started about, some of the points of differentiation comparing one clearinghouse to another. A lot of those comparisons may go away because the regulators, won't let us compete on, to let us have a riskier offering to make it cheaper. We're in the business of managing risk. We wouldn't want to do it, and even if we did, the regulators wouldn't allow it. So, so I think in terms of, just having a sound structure that, and risk protection, I think you should be able to expect that from, any credible, licensed OTC clearinghouse, which is good news for all of us as an industry participating in the market. So I think going beyond that, then I think it makes sense if you're choosing a clearinghouse to look at whether there are special aspects of their service or their approach or philosophy of risk management that is that is supportive to your particular portfolio, your portfolio structure, the way you do your business, because there may be operational things that lend themselves. There may there may be offerings in different currencies between one clearinghouse and another that are kind of fit your style of portfolio. So those can be important. There may be some differences in kind of the way the clearinghouse is structured. This is getting a little technical, so apologize. We'll get to Calypso's drinks soon, but trying to create a stampede for the balcony here. But between kind of the way technical things like the allocation between how the clearinghouse, how much emphasis they put on margin versus the default fund, that may have important implications if one of your concerns is, hey, if I need to move positions from here to there, a bigger, a lot more bigger balance in favor of margin may actually make that easier. And so, there may be aspects of that, and I think that the last point I'd like to make on this is, Mark's absolutely right. I mean, a lot of these things are, pretty technical and pretty detailed, and I think Corry and Mark would say the same thing. But we're definitely, part of what we're doing. We really are, working with customers like the banks and the clients and people who are thinking about what to do. It's an educational process and kind of translating a lot to this. And what does it mean to me? What does it mean to my portfolio? And making sure you get clear explanations of that so you understand what you're going into. I think that's going to be very important as well.
Ditto. Yeah, I mean, if I had to look at my list here, obviously, I mean, one of the things that,
you have a list?
I do have a list.
That's no fair.
Yeah. Well, I saw some notes. So, absolutely.